Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. ALM strategies. Asset-liability management strategies are crucial for the effective management of financial risks associated with the mismatches between assets and liabilities. In the context of an Associate Professional Risk Manager course, the emphasis on ALM strategies provides a foundational understanding of the techniques used to ensure that an institution can meet its financial obligations while optimizing its financial performance. ALM strategies are employed by a range of financial institutions, including banks, insurance companies, and pension funds, to manage the risks arising from changes in interest rates, liquidity, and currency exchange rates. The core objective of ALM is to manage the gap between assets and liabilities to mitigate risks and ensure the stability and profitability of an institution. One of the primary strategies in ALM is duration matching, which involves aligning the duration of assets and liabilities to minimize interest rate risk. Duration is a measure of the sensitivity of the price of a financial instrument to changes in interest rates. By matching the duration of assets and liabilities, an institution can reduce the impact of interest rate fluctuations on its net worth. For example, if a bank has long-term loans as assets and short-term deposits as liabilities, it faces the risk that rising interest rates will increase the cost of its liabilities faster than the income from its assets. By adjusting the duration of its assets and liabilities, the bank can hedge against this risk. Another important ALM strategy is gap analysis, which involves assessing the difference between the amounts of assets and liabilities that mature or reprice within specific time periods. Gap analysis helps institutions identify periods of potential liquidity shortfalls or surpluses. A positive gap indicates that an institution has more assets than liabilities maturing in a given period, which can be advantageous in a rising interest rate environment. Conversely, a negative gap suggests that liabilities exceed assets maturing in the same period, posing a risk in a rising interest rate scenario. By conducting gap analysis, institutions can devise strategies to rebalance their portfolios and manage liquidity risk effectively. Liquidity management is another critical aspect of ALM. Ensuring that an institution has sufficient liquid assets to meet its obligations is essential for maintaining financial stability. Stress testing and scenario analysis are commonly used techniques to assess liquidity risk. These techniques involve simulating various adverse scenarios, such as a sudden increase in withdrawals or a market downturn, to evaluate the institution's ability to withstand stress. For instance, during the 2008 financial crisis, many institutions faced severe liquidity shortages due to unexpected market conditions. Institutions that had robust liquidity management strategies in place, including adequate liquidity buffers and contingency funding plans, were better positioned to navigate the crisis. Currency risk management is also a vital component of ALM for institutions with exposures to multiple currencies. Foreign exchange rate fluctuations can significantly impact the value of assets and liabilities denominated in different currencies. To manage currency risk, institutions use various hedging instruments, such as forward contracts, options, and swaps. These instruments allow institutions to lock in exchange rates or protect against adverse movements in currency values. For example, a multinational corporation with revenues in multiple currencies can use currency hedging to stabilize its cash flows and protect its profitability from exchange rate volatility. In addition to traditional ALM strategies, institutions are increasingly incorporating advanced quantitative techniques and financial models to enhance their risk management capabilities. Value at risk and economic value of equity are two such models widely used in ALM. VR measures the potential loss in value of a portfolio over a specified period, given a certain confidence level. It provides a quantifiable estimate of the maximum potential loss, helping institutions manage their overall risk exposure. EV, on the other hand, assesses the long-term impact of interest rate changes on the economic value of an institution's equity. By considering the present value of future cash flows, EV provides a comprehensive view of an institution's interest rate risk profile. Moreover, regulatory frameworks play a significant role in shaping ALM strategies. Financial institutions are subject to various regulatory requirements aimed at ensuring their solvency and stability. For example, the Basel III framework, introduced by the Basel Committee on Banking Supervision, establishes stringent capital and liquidity standards for banks. Under Basel III, banks are required to maintain higher levels of capital to absorb losses and ensure adequate liquidity buffers to meet short-term obligations. These regulatory requirements necessitate robust ALM practices to comply with the prescribed standards and maintain financial resilience. Empirical evidence underscores the significance of effective ALM strategies in mitigating financial risks and enhancing institutional stability. A study conducted by Cosmeto and Zopunidis on Greek banks found that banks with well-implemented ALM practices exhibited better financial performance and lower risk levels compared to those with inadequate ALM strategies. The study highlighted that banks with a proactive approach to managing interest rate risk, liquidity risk, and currency risk were more resilient to market fluctuations and economic shocks. Similarly, a report by the International Monetary Fund emphasized the importance of ALM in maintaining financial stability in emerging markets. The report noted that robust ALM practices helped institutions in emerging markets navigate periods of economic volatility and currency depreciation, thereby contributing to overall financial stability. In conclusion, ALM strategies are fundamental to effective risk management in financial institutions. By aligning the duration of assets and liabilities, conducting gap analysis, managing liquidity and currency risks, and employing advanced quantitative models, institutions can mitigate the impact of interest rate fluctuations, liquidity shortfalls, and exchange rate volatility. Regulatory frameworks further underscore the importance of robust ALM practices in maintaining financial resilience. Empirical studies corroborate the positive impact of effective ALM strategies on financial performance and stability. As financial markets continue to evolve, the importance of ALM in safeguarding institutional stability and optimizing financial performance remains paramount. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.